Welcome to the Startup of the Year podcast, where each episode we showcase exciting new companies from around the world. This podcast is produced by Established, creators of the Startup of the Year program. Established is focused on helping organizations with their innovation, startup, and communication strategies.
Alrighty, welcome back to the Startup of the Year podcast. I'm Frank Gruber. This is episode number 60. Can you believe it? How exciting is that? I'm Frank Gruber, the co-founder and co-CEO of Established and the co-founder of Established Ventures, the team behind the Startup of the Year podcast, and this very community that you're a part of. Thanks for being here. If you're not a part of it, you should join immediately, and I'll tell you more about that shortly. But in this episode, we want to hear from a very special VC that's been growing his brand is Firebrand Ventures, a seed venture fund for the last few years. Before that, he was at Techstars, and he's worked on a number of different programs for them as managing director prior to starting Firebrand Ventures. We're talking about John Fein. He talked with us at the summit in 2020 that we hosted, and looking forward to hearing more about what he's been up to and sharing his insights, as he's got a lot of knowledge. Prior to Techstars, he was also at UnitedHealth Group, where he managed large-scale projects, including scaling businesses from 0 to 1.5 billion per year and over 1,500 employees in 4 years. So a lot of experience, really smart guy, and excited to hear from him shortly. But before we get to that interview, I wanted to share a segment from our very own Rich Malloy of Established and of Established Ventures with the VC Minute. Rich, take it away.
Hi, this is Rich Malloy with Established Ventures, bringing you the VC Minute. Quick advice to help startup founders fundraise better. Let's talk about pausing the VC treadmill. If the VC treadmill is the process of raising money to grow your business to hit milestones for the next round of growth, then what happens when you miss your milestones? You have 3 choices. 1, raise the dreaded bridge round. 2, go out of business, including various forms of acquisition. Or 3, something often overlooked, adjust your business to focus on break-even or profitability. Even in my limited experience, I've seen all of the above happen to great founders. Let's talk about the third case, adjusting for break-even. Just like being on a treadmill at the gym, you can slow the VC treadmill down at any time. I want to tell you about one portfolio company that struggled through 2020. They pulled way back on their burn rate. They took salary cuts, stopped new hires, and dug in deep to focus on their core line of business. In a year of breakout successes, preemptive rounds, and abundant capital, they were not experiencing any of that in their world. But by the end of the year, through grit, determination, and an intense focus on unit economics, they turned the year around, grew revenues, and got back to full salaries plus expansion hires, all supported by a stronger business model. These founders are now in a position where they get to choose whether or not they want to step back on the treadmill. And I couldn't be more proud of them. When you take growth capital, you have a responsibility to your investors to do everything you can to hit those milestones. But if you miss, you don't have to burn it to the ground. You can pull back, slow down, and refocus to emerge with a stronger business. Whether you've already raised venture capital or are considering it, remember, you're in control of the business. That is, as long as you're in control of the board. But that's a topic for another time. That's all for the VC Minute. Back to you, Frank.
Thanks so much, Rich. Really great stuff. For those of you startups out there raising, obviously this is helpful information for you as you're out there doing your thing. And really appreciate your support, Rich, and helping these companies out. So thanks for sharing those VC Minutes. Keep them up. All right. Before we get started with that interview again, I wanted to say one more thing, actually a special thing, because this week is actually special to me. It's been 15 years since we first hosted our first tech cocktail event, which was a special event that was hosted in Chicago in 2006. It brought together the community, showcased startups, early stage startups, and brought together the tech community as well as all the folks that were involved at the time. We had a couple hundred people showcased. Yes, there was, libations and a few hors d'oeuvres, and it was really a beginning of a movement that led me to, growing that out as a side hustle and into a full-fledged media company at tech.co, where we grew the online audience from zero to millions or tens of millions of readers all around the globe, and eventually had the media component acquired in 2018. So really great start to a journey 15 years ago this week. And so obviously I'd love to reflect on that and how far we've come. And now we're continuing on our efforts in helping better connect startups with the Startup of the Year community and our efforts at Established and Established Ventures. So really great stuff. And obviously we'll always remember those fond memories of our events in Chicago and DC and Austin and Boston and Boulder and all these different places, Detroit, and you name it. We were all over doing these events and bringing together community before there really was the connective tissue that social media and social networking brought. We were doing it kind of early. So it was a really phenomenal thing at the time when you actually got to connect with somebody at an event that you just saw post something online, or maybe you saw their profile for the first time, and now you got to meet them in person. And now that's become really trivial, right? Fast forward to today, where there's lots of apps doing that in the dating scene, for example, and obviously LinkedIn is a huge establishment and whatnot. But it's really fun to remember all those stories and some of the companies like Grubhub and Groupon and even Uber and Living Social and the list goes on and on. So Belly and others. But long story short, the reason I'm so fond of it is it kicked off my entrepreneurial career and got me in a place where I'm able to continue to do this for a living, and as well as myself and Jen Consalvo and the rest of our team of folks that are really all about helping the entrepreneurial community. And now we're able to do it full time as a job, and as well as invest in the companies that we like and really believe in through Established Ventures and our other work. So just wanted to take a moment to reflect, as we wouldn't be here on the 60th episode without that first tech cocktail event in Chicago in a warm Lincoln Park newly established place, where we were just getting this thing going. So anyway, if you remember it, love to hear from you. Love to hear always about the fond memories and some of the things that you took away from it along the way. So shoot us a comment or shoot us a note. We'd love to hear from you. And for those of you wanting to get involved in this community, this growing community, you can join it by just filling out a simple application. It's part of our 2020 Startup of the Year Community and Awards. Our awards are coming up in the fall, and you just have to go online to apply. And to become a part of that, you just have to meet a few requirements: raising less than $5 million in funding and having a functional prototype. You can apply, soty.link/apply, and you'll be a part of this amazing growing community. We've got our top 100 startups that apply this year will actually be taken on to our summit, where they'll showcase, get a chance at connecting with other founders, entrepreneurs, investors, and corporate innovators, as well as a chance at the title of Startup of the Year. So it'll be a lot of fun. I'm looking forward to it, and looking forward to a little bit more of normalcy as we go back to that after the pandemic. So a lot going on there, and just apply at soty.link/apply. Should be a lot of fun, and we'll be announcing more details about that soon. So stay tuned for that. Next, I want to share a little bit more about one of our founders' stories and partners, Finmark. They're a partner, portfolio company, and alumni of the Startup of the Year program. They came through our program last year. I've talked about them a few times, but I wanted to share one more tidbit about them. If you're a startup, you should be checking this out, because it's actually a financial planning software for startups for forecasting revenue and cash projections and runway. All the key critical things for creating a startup, because all those items and cash in general is oxygen for your business, and you'll want to know exactly how things are going. So there's a few products out there that do this, one of which is Excel, and you can always make mistakes in that, and that's been the kind of de facto. So really important for you to check out Finmark over at est.us/Finmark. Again, it's est.us/Finmark, and that will actually get you a 30-day free trial of Finmark on us. So be a part of our community, and look, you've got perks. So check it out, est.us/Finmark. And if you don't like it, you can always quit before the 30 days, and nothing, no harm there. But I think you'll probably find it helpful in your journey. So I wouldn't be mentioning it if we didn't think so. All right, so let's listen in to that interview with John Fein from Firebrand Ventures.
John, you've been both a startup founder and an investor. Can you share a little bit about how you moved from founder to investor and what that transition was like?
Yeah, sure. So I was a founder. You know, I was also a part of 4 other startups where I was a non-founder but early employee, and I had worked for those 5 startups back to back with no break, and that was back in the day. So this is like from '97 to 2005, and after having done the 5th one, and by the way, none of them were home runs. We had a couple singles or doubles, but there were no home runs there with those 5. And so after the 5th one, I told my wife, I was like, I just want to get a normal job for a while. And so I got a job with a healthcare company called Prescription Solutions. And that's the business that took me from San Diego to Kansas City. And that was that big project that I ran for them. Scaling an operation from scratch, which was an amazing experience. And that was very entrepreneurial, even though it wasn't a startup. And so I ran, these multi-billion-dollar projects for Prescription Solutions. That company got acquired by UnitedHealth Group for $8 billion. I started running the largest projects for United, again, multi-year, multi-billion-dollar projects. Started losing my mind because it was a huge, massive corporation, and it was very bureaucratic and political, and a lot of smart people, but I just didn't function very well in that environment. And so I ended up just starting to network in the startup community in Kansas City, which was just fortunate timing on my part because it was 2012 and when the startup community was really taking off here. And one thing led to another, got connected to Techstars, and that's how I really started my investment career. It was when I joined Techstars as managing director in 2013. It gave me the opportunity to invest out of the Techstars fund in 30 companies over 3 years, running that accelerator. And that's really, it was like a crash course on being a professional investor. So it was great.
I bet. That's great. So can you maybe explain to our viewers how Firebrand Ventures differs from maybe other venture groups, or what industry you guys look for and companies you invest in?
Yeah, absolutely. So Firebrand was born out of a notion that there weren't enough sort of straight up pure VC funds between the coasts. When I was running Techstars, I noticed that there were a lot of very fundable companies in the Midwest that had to go to the coasts to get funded. And not only did they have to raise from the coast, sometimes they had to move to the coasts. And that's no good because you have startup communities that are fantastic that are losing great founders just because there aren't enough investment dollars there. Sure. And so that was the initial sort of inspiration to launch Firebrand. And as we sort of honed our investment strategy, it became really clear that not only did we like to invest in founders in sort of traditionally underserved, underinvested communities, even communities like Austin, Boulder, Denver, Chicago, they have fewer investors than you would think. And so we also started looking at the specific types of founders that we like to invest in. And it became clear to us that trust is a really, really important part of the founder-investor relationship. And so we started, talking about things like we invest in trusted relationships with exceptional founders, really emphasizing that we like to even build that relationship with founders before we invest. And then we brought on my partner, Chris Marks, who's based in Boulder, and his previous funds thesis really revolved around authentic leaders and investing in authentic leaders and authentic founders, and that just fit right in with what we'd already been doing. And so those are some of the ways I think that sets us apart. We really operate on a human level. We're not transactional. We like to get really involved and help the founders. And at the end of the day, the founders are our customer. And we feel like even just having the founder as our customer, at least between the coasts, I feel like that probably sets us apart a little bit.
Sure. And I have to ask, and this may be a goofy question, but the name Firebrand, where does that come from, if I might ask?
Yeah. So the definition of Firebrand is a person who is particularly passionate about a cause, often inciting change and taking radical action.
Oh, wow.
And so when I when I realized a lot of people don't, and I get that question a lot. I actually have that definition on the back of our business cards because
Nice.
it gets asked so much. And so once I realized what Firebrand meant, I was like, oh man, this is right up our alley.
Sure. Now I have to ask also too, another follow up to what you had mentioned. So you said that the fund is built on relationships and trust, which is great, by the way. Do you have any tips or tricks or any ways that you manage that trust or you can scale that? And I hope I'm asking that the right way, right? But as you grow your portfolio, to be able to have those manage those relationships, I guess.
Thing, in any relationship, it can take a while to build, but all it takes is one little thing to destroy it. And so I think it's about being really deliberate about building that trust from day one. And you can only do it through action, right? You can talk, you can have awesome, talking points and messaging, but really it takes action and it's a two-way street. For us, it means that, we have to walk the walk, right? Like we have to be a huge fan of the founders that we invest in. We have to do what we say we're going to do every single time without fail. Be totally transparent in everything that we do and say. No hidden agendas, no fine print. Like all of our investment terms are super standard, for example. We're just upfront with everything we do. We're also upfront about the fact that, hey, we're also funded. We need to make money, right? So, we're really upfront about the percentage stake that we're going for in the company. If there's any term in any investment document the founders ask about, we make sure to explain why that term is in there. But even though they're always standard. So I think all those little touch points that I just talked about and all the little conversations that you have with founders, every single one of those touch points builds trust.
Sure.
And actually, trust is easy to scale once you get to the point where it's really solid, because once it's there, you don't have to do anything else. You just have to make sure you don't screw it up.
Right.
So for us, it's the best thing about it for us is we just get to be who we are. We don't pretend to be anything other than who we are. If we say that we want to invest in authentic founders, we better be authentic ourselves. So we just kind of wear it on our sleeve, and if it's a fit, great. And oftentimes, sometimes it's not a fit. There's no connection with the founders, and that's okay too. It all works out.
Of course, yeah. That's all good. I like your style. We'll put it that way. So I'm getting some questions here from the audience. So let me get into those, and I hope I ask these correctly. So the first one's pretty easy to ask, anyways. What verticals get you the most excited today?
I'm a big fan of cybersecurity. We have a few of those in our portfolio. We like fintech. Fintech can be tricky these days because there's so many fintech startups out there. You need to make sure that the products are truly differentiated, but do love the fintech space because there's so much more room for disruption there. Definitely intrigued by a phrase that is now overused called future of work, but definitely intrigued by how companies are developing solutions for this sort of new environment we're all finding ourselves in. Some aspects of that environment might be permanent and long-term, and so very intrigued with that as well. Overall, we're fairly sector agnostic. There's some sectors we won't invest in. 9 times out of 10, we're going to gravitate towards B2B software because that's what we know.
Sure. Okay. Another question just came in, and I don't know, your AirPod may have died. I'm not sure, but the mic's kind of coming out in and out a little bit. So just wanted to give you a heads up. But I have another question, if you can hear me, hopefully, from Mark. He says, what's your advice for an industry-specific marketplace that is launching their MVP where supply problem is solved, but branding to the demand side isn't, with limited marketing resources?
Can you hear me okay, by the way?
Yeah, much better now. Thank you.
Sorry about that. Could you repeat that question?
Yes. What's your advice for an industry-specific marketplace that is launching their MVP where supply problem is solved, but branding to the demand side isn't, with limited marketing resources?
Well, that's always a challenge with marketplaces, right? It's really hard to get a balance between the supply and demand. It's a case by case situation. It all depends on what sector you're in, what the demand side of your marketplace looks like. Who are these people you are trying to get onto the platform? I would say, part of it is probably just marketing 101, which is, meeting those customers where they are is really important. Understanding where they are, understanding their motivations, building those customer personas is really, really important. I also think it's important to make an honest assessment of, is this making sure that marketplace itself is viable as a two-sided marketplace. I think sometime we've seen in some cases, not always, but startups really getting excited about marketplaces where only one side is, it's fairly evident how to acquire those customers, but the other side, it's kind of a mystery.
Sure.
And the only other thing I would say beyond that is run a lot of experiments, run a lot of little experiments. It's the best way to figure out how to acquire customers. And you can do that on a small budget, by the way. There's a lot of tools. There's so many tools out there. You don't need a huge digital marketing budget. There's a lot of experiments you can use with existing tools that are out there.
No, all good words of advice. So I have some questions here too, and I want to have a little bit of fun with this. And don't feel, I don't want to give away any secrets here or anything. But what do you feel are your most successful investments? And then the second part of that is, are there any deals that came across your plate that, looking back on it, you kick yourself that you really wish you would have invested in at the time?
Yep. So, some of the most successful investments we have, one of them is a fintech company that does programmable ACH transactions. Another one is a cybersecurity company that deals with endpoint security, and they've grown quite well. And again, we continue to be really excited about cybersecurity. Another one is a data analytics company that tracks the movement of goods and people within cities and states and packages up that data and markets it to municipalities and states to help them plan for the building out of their own infrastructure. And then we have one or two e-commerce companies that are doing quite well in this economy, especially with COVID and people buying so many more goods online. So yeah, I mean, we have a fairly diverse portfolio. For us, in the beginning, it always comes down to the founders, always comes down to the team. We over-index on the team by far. And that's, so far that's served us pretty well, knock on wood. And then deals that sort of are anti-portfolio, like deals that we wish we would have done, but we didn't do. We're still fairly early on, so I think that the jury's still out. We're 4 years in. One of them, I guess, I'm sure they've struggled a little since COVID, but I'm sure they'll come back, is a company that they sell basically like these packages of items that rideshare drivers can sell to their riders. And when we first met them, they were really, really early. So it's like, you're talking about like candy bars and like knickknacks and like things like that. Well, when I first met them, they were in Accelerator, and their prototype was terrible.
Right.
And it was my fault because I couldn't visualize what it could become. I was just looking at their prototype, which it was like a couple of Snickers bars, like in one of these plastic like travel cases.
Right.
How are you ever going to sell this to drivers? Like, I just didn't get it. And the bottom line is it took off before COVID. It took off.
Oh, wow. And
they raised a really big round from a top tier VC. Again, I'm sure they've they've taken a hit, but you know, I've no doubt they'll come back. And so that's one that I failed to visualize, and you know, that was my fault.
Sure. Sounds like you have a nice assortment of portfolio companies. And I personally always, I like the tech-enabled service companies that aren't necessarily the most exciting companies, but when you look at some of their metrics or KPIs, you know, they get me excited anyways, even though I'm usually the person at the table that everyone else disagrees with for some reason. But you brought up a good point there about, you know, investing in the founders. So let me ask you, what characteristics do you look for, do you value most in the founders that you talk to that pitch to you?
Yeah, basically like being authentic right off the bat, right? Being authentic, transparent, honesty, integrity, just putting it all out there. You know, I think in some cases, and maybe this is more evident in Silicon Valley than other places, but I think some founders are sort of advised that fundraising is a game, and you want to game the system as much as possible, be super transactional, get the highest valuation, doesn't matter from who, you know, those types of things. We're really the opposite of that. You know, we look for founders who want to build a relationship, who value the relationships with their investors, just like they do with their mentors or advisors, and are really obsessed with solving a big problem in a better way. I think it's easy. It's not easy, but it's relatively easy to be different with your product, your solution. It's really, really hard to be different and better. And so, you know, we love founders who think about that in a creative way and are incredibly just obsessed, in not an unhealthy way, but very obsessed and driven, because we also believe that we've gone through startup life ourselves as founders. We know how much of an emotional roller coaster it can be. And you need that fire, that obsession, more than passion, I think. You need that obsession to drive you and just get through that every day. And so much of startup success and founder success is persistence.
Right.
And just, you know, there's so many, you know, look at all these stories we have of these, you know, incredibly successful companies that were on the brink of failure over and over and over again. And that's more common than the opposite of, you know, of just a smooth ride upwards. But the founders figured out a way to power through, and it was almost always because they were obsessed. And so those are some of the things that we look for. There's a long list, but probably those are the top ones.
Great. So I have some more questions coming in here from the chat. So let me get to those here. What do you think about the future of e-commerce, and what trends are you seeing in 2020 that'll be going into the new year?
Yeah, that's a great question, because, you know, it's very tricky right now for e-commerce. So I'll just give you an example. So first of all, e-commerce has done amazing since COVID. More people are home, more people are shopping online. They're not going to stores. Maybe they're a little bored and they're doing some, you know, impulse shopping. I don't know. Sure. But you know, it's gotten sort of this artificial bump. And so now the question is, what is it going to be like in 2021? You may have noticed the public markets the last few days have been rallying. The Dow's been rallying, but it's a different type of rally that's happened. They're rallying on the news of these vaccinations. Maybe there's some more stability in the White House, whatever the case, but it's more of a post-COVID rally. It's not that we're post-COVID, it's that the market's looking forward to that. Well, in these rallies that have happened, Amazon, the biggest e-commerce company in the US, has gone down. Their stock has gone down during that rally. So the question is, will the e-commerce sort of rally that's happened so far, this should be able to continue into next year? My guess is it will gradually go back to pre-COVID levels. Having said that, I think if you have, you know, an amazing product or amazing platform that is e-commerce based, it's always going to be successful in any market. We just think that it's tricky right now to forecast how the sort of in COVID and versus post-COVID markets are going to affect e-commerce. And my guess is they'll probably revert back to the mean a little bit more.
Sure. Makes sense. 2020 has just been, in general, I think, hard to forecast. So,
Yeah.
but anyways, I got another question that came in here. As an investor, how would you prioritize the following? Your team, the company's team, the portfolio company team, product, traction, and TAM, total addressable market.
Yeah. Team's way up there. So if it was a visual, the team would be like way up here at the top. And then, we probably the next one down would be product. We really like to dig in on the product. Traction is maybe a close one right after that. And then probably the TAM is last for us. And the reason why that is because markets change, markets shift. Yes, we have to love the market of any company that we invest in. But oftentimes it's not even necessarily the market that is today. It's what we believe the market will be in the next 3, 5, 7, 10 years. Sure. But yes, team is what makes everything go. We are not the type of investor to invest in a company and think, we love the product of the market and maybe we'll replace the CEO, or maybe we'll replace this person. That's just not our business. We don't do that. So we have to really have extremely high conviction in the team. And by the way, the product, the traction, and the market are all a reflection of the team anyway, and how they're thinking about all those things. And so to us, that's our North Star always comes back to the team.
Right. So I have to ask this because a lot of our audience out there are startup founders that are looking, to grow and scale their business. And then also a lot of them are raising capital, which is a full-time job these days, it seems like. So what tips do you have for startup founders that are pitching to investors out there?
I'd say first and foremost, and this is not easy, I recognize, because I've been in this position myself many times. Do the very, very best you can and iterate on your message so that you can communicate to the investor what you do in a clear, concise, and compelling way. It's really, really hard to do. I can tell you that most founders aren't quite there yet. But if you can do that, that almost gives you an advantage, just being able to do that and be super, super clear about what you do. What are your 2 to 3 top value props? What really sets you apart? 2 to 3 bullets. That's it. Not like a verbal paragraph. Just right to the point. Why is your team the team to do this? Your team does not have to all be from Google and Amazon and Facebook, whatever. That's not a requirement. And by the way, you don't have to be from an Ivy League school either. But you do have to communicate why your team is the right team to do this and why the right time to do this is now. And so really honing in on those things and being super, super clear and concise it really goes a long way. One thing I would tell founders is don't try to tell your life story or the life story of the company in your first pitch, even your second pitch. You want to get the investor interested. You want to get them intrigued. It's almost like a job interview. You want to get the next meeting. And so just hit them with the high points, hit them with the most compelling story that you can, and stay away from words like, we think we can do this, our plan is to do this. Eliminate all tentative words from your vocabulary and be like, this is what we are going to do. We're going to do this. We're going to do this. We're going to do this. Like that's another thing I think that really, really helps to inspire confidence with investors.
Sure. Well, I have about 10 pages more of questions, but I need to do the audience here justice and ask them. I have some more questions rolling in. So one question here is, we are a healthcare technology company. Our solution is applicable to COVID as one disease, but we do not want to be labeled or shown as a COVID company. When contacting investors, how much weight should they put behind being a COVID company versus the other?
Yeah, I think I think they're thinking about it the right way. And there is a risk to just being pigeonholed as a COVID company. We don't know what the vaccines are going to look like next year, but clearly they're coming out. There's going to be a light at the end of the tunnel. So I think it is important to have both parts of the story in there.
Sure.
And so one example that might be, hey, look, phase one, we're taking advantage of this COVID situation. We think we can add value here, here, and here, and start to build the foundation of our business. Phase two, we're going to be taking that growth and leveraging it to attack this in our phase two. I think that is a completely valid story. I think it's a good sort of jumping off point to use COVID, the COVID opportunity for that, but it doesn't pigeonhole you to be a COVID related company forever.
Sure. And, we're running out of time here, but and for our investor attendees that may be watching, what are your thoughts on some of these other strategies that differ from your historical VC type of investments, right? Like revenue-based investing or crowd-based investing. What are your thoughts on some of those that are kind of emerging lately?
My attitude is, hey man, like whatever gets startups funded, we're fans of entrepreneurs, whether we invest in them or not. And so for example, I have a really close friend of mine here in Kansas City. He runs a revenue-based fund, and I think it's awesome. So I think the more the merrier, as long as they're good investors, right? As long as they're good actors, they're good faith players in the system. And if they're putting more capital in and giving founders, a better chance by giving them alternatives, I think that's awesome.
I like that answer. That's great. So John, lastly here, is there a way that you would prefer them to connect with you if applicable?
Yeah, plenty of people connect with me on Twitter. And so my handle is at John Fein, JOHNFEIN. They can always reach out to me there.
Thank you so much, John. I'm hoping our listeners learned a lot from your VC insights. I certainly did, and appreciate your time. Best of luck with your future funds and everything you're doing in the startup community. We'll be following along and cheering as well. All right. Hope you enjoyed this episode. Hope you found it interesting and maybe you learned something, you took something away from it. Maybe it's inspiration, maybe it's just knowledge. Please do, if you did, please share it with someone you think will find it helpful. We believe in sharing, and sharing is caring. So please do continue to amplify what we're doing, is because we want to make sure this gets out to everyone as a way to continue to improve upon what they're up to. And if you have a startup idea and you want to get something going, today is the best day to start up. Not tomorrow, not the next day. It could rain, it could snow, who knows what could happen. And in doing so, I encourage you to join our startup community. For access to support, expert advice, and resources you will need to elevate your startup to the next level. Just simply go to soty.link/apply and start today. We'll be with you to help you. Until next time, I'm Frank Gruber signing off. Thanks again for listening. Wishing you the best of luck and future success with all of your ventures.
Thanks for listening to the Startup of the Year podcast. Be sure to subscribe, and we'll be back with another episode soon.